Well, good afternoon, everyone. My name is Todd Christensen. I work with CapEd Credit Union. I work as the SVP of Advancement and Member Experience. We're glad that you have joined us here on our, I think we are at our fourth webinar of our 13 webinar series called Lunch Money, a financial well-being webinar series. So we're glad that you're here with us today. We do have several other webinars that are coming up both this next week and the following week. Give a quick reminder and a shout out to everybody for those who have joined us for several of these. Thank you for doing so. Coming up next week, we have our VP of Consumer Lending, Jenny Sanford. She's going to be talking on Tuesday, October 20th, about credit scores. How's your credit score made up? What can you do to improve your credit score? What items do you need to be cognizant or aware of that could damage your credit score, and how the credit score is used by financial institutions like us as CapEd on how we use that to determine your rates on the lending side. So it's a great webinar. Tune in on Tuesday, October 20th at 12:15. Then on Thursday, the 22nd, Thursday the 22nd, we have Carrie Wardell from Idaho Public TV with changes taking place with our school districts and many of them here in the Treasure Valley, considering how they want to approach the continued school year. Carrie will share resources that are available for families while they are working with their children in a remote environment. So that comes up on Thursday, October 22nd. But today we have a great topic. I have often said that I really dislike insurance because I don't necessarily understand it all. It seems to change on a regular and frequent basis. But I have found a gentleman whom we at CapEd work with, and his name is Mr. Steve Marsh. We'll introduce him here in a second, but let me first of all introduce Jeremiah Bates. He has also joined us again as a guest presenter today. He is with Tree City Advisors, and he'll help with some of the technology today as well. But let me turn back to and let me introduce Mr. Steve Marsh. He is the owner broker of Medical Plans of Idaho. You can also hear him on the Real Money program on KBOI Monday through Thursday, Monday through Friday on 670 from 6 to 7 p.m. And he definitely does take the mystery out of insurance. So with that, Mr. Steve, let me turn it over to you. Welcome, Steve, and thanks for joining us today to demystify insurance. Steve?
Absolutely. Thanks, Todd. Thanks, CapEd, for allowing me to be a part of this and not only help your members, but anybody else out there that just has questions and concerns about insurance. Jeremiah is with us here, like Todd said, with Tree City Advisors, and Jeremiah has helped me in many situations where we just have lots of questions and concerns, and Jeremiah has lots of great answers when it comes to the tax credit situation with individual policies, and we're able to work together to help a lot of people figure out what's the best way to keep their income where it falls within the range to qualify for tax credit. So Jeremiah, thanks for being here. Chime in anytime you've got something to say.
Yeah, no, Steve, thank you for letting me join you. And Todd and CapEd, thank you for letting us be a part of this Lunch Money webinar series. We're certainly appreciative, and we're excited for everyone who's attending. And the way I'm going to stage this is I am the Robin to the Batman, which is Steve. He's the expert when it comes to the insurance. But what I certainly appreciate about Steve is our coordination. Our firm, we're financial advisors, so we're looking at the whole picture, and a big part of that picture for financial success, retirement success is around the insurance. Like Todd mentioned at the top of this, I'll be the first one to admit this. It is confusing. It changes consistently. So having an expert, a specialist who knows the intricacies and the dynamics of these is very important. So I'll be chiming in just to kind of chat about, how there's tax efficiencies that can be built in through certain healthcare plans and certain accounts and things like that. So Steve, I'll let you drive the car and I'll assist when needed.
Perfect. So the other thing I'll just tell you a little bit about myself is I do have what are called environmental allergies. So if I have to clear my throat or cough or something for a second, we'll move right along and get through that together. So Todd, go ahead and move to the next slide. So to give you a little background about myself, I entered the business back in 1994. I got licensed in 95. I've been an independent agent that entire time. Part of it was just as a typical insurance agent out there, like many. But at a point, I decided I wanted to get into marketing, recruiting, and training agents. So I did that here in Idaho for 3 years. Well, actually, I did it for about 15 years in 3 different states, which led me to becoming what's known as a marketing and managing general agent, where you have lots of agents that you're working with on a day-to-day basis, and that led to becoming a national independent organization. Then we had this thing called the Affordable Care Act, or Obamacare, came in, and it kind of changed the landscape of the insurance market, which pretty much brought me back to the beginning days, back to just becoming a general agent and just an independent agent out working in the market. So I've done this for a long time. I've seen a lot of the trends come and go, and one of the most important things for me is just educating people and making sure they understand what they're actually purchasing. It doesn't do anybody any good to just buy something that really doesn't fit their needs. So if we go on here to the next screen, what we'll start with is we're going to talk about medical insurance or health insurance. And generally, there's 4 ways that we obtain insurance today. First is the vast majority of people are covered through an employer-based group health plan. And then, of course, those who are not, we go out to the individual private market and we buy an individual health plan. And the Department of Insurance in Idaho actually regulates insurance. So there's about half a dozen insurance companies here in Idaho that are licensed and have authority to do business here. In addition to that, we've got Medicaid, which is generally for people whose income is below 138% of the federal poverty level. And of course, then there's seniors, which we cover through Medicare. Go ahead, Todd. So the topic today that we're going to hit is we're going to hit on health insurance. We're going to go through the ABCs of Medicare, life insurance, and disability. And of course, we want to try and move through this as quickly as we can so that we can get to some points where we can answer any questions that you might have. So the first place that we start always is employer-based coverage. Most people in Idaho are going to get their coverage through an employer. It's a tax, it's a pre-tax benefit. Most of the plans today, you've got multiple plans within an employer sponsored health plan to choose from, which is great because it gives us choices that we didn't have, say, 5 or 10 years ago. But if you can get it through an employer, it's generally the best way to do it. If we have to go to the private market, we're either going to buy the coverage either what's called off the exchange or on the exchange. And if we go off the exchange, what we're doing is we're buying it directly from your favorite insurance company like Blue Cross of Idaho or Select Health. It takes a lot less time to do it that way. It's the same plans that are on the exchange at the same rates. It's just we have a different channel for getting the information to the carrier and obtaining the coverage. If we go on exchange, the reason we generally go on exchange is simply because we want to get an advanced premium tax credit. That's what APT stands for, advanced premium tax credit. And in order to get that, there's eligibility guidelines, and of course there's income requirements as well.
And just to chime in here on the advanced premium tax credit, a simple way to put that, it's a part of the Affordable Care Act, aka Obamacare, where it's basically a tax subsidized healthcare plan. So if you're able to obtain coverage through the exchange and you meet those requirements, what that means is you get part of your healthcare paid for through these tax credits, whether it's in the form of discounted premiums, discounted deductibles, and all that, which we can get into more details on. But just so there's that.
Yeah, absolutely. Yeah, and if we go to the eligibility piece here, in order to be eligible to buy insurance on the exchange, and this is where about 70 to 85,000 people this year are going to buy their health insurance, is they're going to go to the exchange. In order to do that, you cannot have access to group health insurance. So this is probably the most confusing part, because a lot of times an employer offers coverage. We as employees, we enroll ourselves. Our employer pays a good portion, if not all of the premium. But then we have a cost for our family to be added to the health plan. Sometimes it's just not affordable. And unfortunately, if you have access to group health insurance like that, you're not eligible to purchase a plan through the exchange and get a tax credit. You also must be denied Medicaid. So the first step in applying for a tax credit is you have to be denied Medicaid from the Department of Health and Welfare. You must also not be eligible for Medicare, which means 65 and over. And your income has to generally be between 138 and 400% of the federal poverty level. And we'll get into that a little bit more here in just a minute. The other thing is you have to enroll during open enrollment. So the Affordable Care Act set up parameters, and one of those parameters was an open enrollment period, which starts November 1st and ends on December 15th of each year. Now, anybody can enroll during this time, and when you do, there is no pre-existing condition. The other thing is, if you currently have insurance and then you lose it no fault of your own, you can create what's called a special election period or an enrollment period. And what causes those are things like death, divorce, marriage, birth of a child, adoption. Maybe you relocated from another state into Idaho. When that happens, based on the event date, you've got 60 days in order to get new coverage in place. And so we can use that as a special election.
Thanks to you, Steve. I know that you are extremely busy. I've looked at your calendar and how often you are meeting with clients and individuals to be prepared for that open enrollment. So thank you for your time here on October 15th as we prepare for that open enrollment period. So thank you, Steve.
You're very welcome. Yeah, our schedule is going to get really crazy between now and the 15th of December. So we talked about.
I want to chime in on one thing. So around that special enrollment. So one thing to take into consideration on that is, say if like what would classify as a special enrollment period. So say if you're with one employer that offers coverage and then you separate from that employer and then you get hired with a new employer and they do not offer coverage, that's a perfect example of when that would happen. If you retire, or you have COBRA, where usually through an employer that covers you through an extended amount of time, when that COBRA ends, that would then kick on that special enrollment period.
Yes, that's a special election period. The other thing that happens is we have a lot of people moving into our great state here. And when they do, if they had prior coverage, and this is kind of the caveat, is you had to have prior coverage in your prior state. If you move here, let's say October 1st, and you had prior coverage, then that creates a special election period as well, because most plans are based on local regional areas. And so that would create a special election period where you could come in and either buy direct to the insurance company off exchange, or we could go look and see if you qualify for the tax credit. So, yeah. So if we look at this guide here, this is the 2021 federal poverty list. And if you look at family size, if we just take a family of 4 as an example, the minimum income to qualify for a tax credit would be $36,156. If your income is below that, you qualify for Medicaid. And that's what was voted on and put into place last year, was Medicaid for adults. And so if your income is below that, you qualify for Medicaid. If you're between there and 104,800, you qualify for a tax credit to help purchase your insurance. Okay? It's a sliding scale. You'll also see at the top, there's some additional numbers up there. Like for instance, there's 138, 200, 250, 300. If your income is below 250% of the federal poverty level, you also qualify for another credit, which helps buy down your deductibles. It's called the cost share subsidy. And it only applies to silver level plans in the market. But what happens is you might select a silver plan that starts out with a $6,000 deductible, but if your income's below 200% of the federal poverty level, you might get as low as a $300 deductible. So it buys that deductible down, it buys co-pays down, it buys your maximum out of pocket down. And so that's where the affordable aspect of the Affordable Care Act comes in, is through these credits, it reduces your exposure.
And
But as you can see, if you've got a family of 6, you can make up to $140,000 a year and get credit to help pay for your health insurance premiums.
and one thing that
Provided that your employer doesn't provide the health insurance, is that correct?
That is absolutely correct. Right.
And this is something as financial advisors, we put a ton of weight on this, because when you're looking to potentially retire early and cover that gap between, let's say if you retire at 59 and you're not going to get on Medicare until 65, that's a big headwind of expense that we got to account for from a financial planning component. Now, keep in mind, this is income means tested. So we're looking at sources of income, whether it's from W-2 work, whether it's from passive income, like from your investment or rental properties and things like that. So we want to start there and figure out where's that gross income at. And then if you're close, what vehicles can we use to lower that? And it goes off your modified adjusted gross income. So what can we use to lower your modified adjusted gross income? Well, one of those is 401ks, this traditional IRAs, these pre-tax accounts that you can contribute into that lower your taxable income. Then if you can get underneath these thresholds, then you can save a significant amount of money through the advanced premium tax credit.
Right. And a lot of times, like, let's just look at that top line there, number 2, family size, 68,900 for a couple. There's a lot of times that, that's what we're dealing with is income right there, that 60, 65, 70,000 range. And a lot of times today, what we'll do, and this is where I drag Jeremiah and Tree City in, is, sometimes if you just make an IRA contribution into a traditional IRA, or maybe we buy a high deductible HSA qualified plan and make a small HSA or a full HSA contribution, it brings us down below that 68,000 mark, and they qualify for a tax credit, which could be significant, especially, if you're getting close to the retirement years.
And just to provide some clarity on this too. So let's just say if you're a household of 2 and you take your gross income, your modified adjusted gross income is calculated before your standard deduction. So that's one thing you got to take into consideration. So if you're going to lump up all your income together, let's say you arrive at 75,000 and you're like, shoot, we're so close to getting to that 68,960 mark. Well, the options that could be at your disposal is a traditional IRA if you have earned income. If your employer offers a 401k, these are easy tools at your disposal to put money into to get your income under that mark. Because again, agree with this from a philosophical standpoint or not, this is what it is. And if you have ways that you can lower your income to take advantage of a lower cost healthcare plan, it's a great strategy to implement to save a lot of money over the long run.
Right. Yeah. Go ahead. Thank you. So let's kind of move on to the ABCs of Medicare. I like to call it the ABCs of Medicare simply because there's a lot of moving parts, and there's parts A, B, C, D. Eventually they'll probably have an E. But let's just kind of jump in here. There's 2 different types of Medicare. There's traditional, which gives you the ability to see any doctor that you want to nationwide, as long as they accept Medicare or Medicare assignment. And then there's what are called Medicare Advantage plans. These are private health plans that are in a contract with Medicare. And you must use the local network providers in order to get that coverage. When you're outside the local area, though, you're always covered for urgent and emergent care. Sometimes we can still access what are called PPO networks, but most of these plans are going to be what are called HMOs. So go ahead and move to the next slide. So in the ABCs of Medicare, you'll see on the screen here, we got 2 parts. We've got Part A and Part B. Part A is something that you have paid into all your life. So when you see on your paycheck stub that there's a Medicare payment or a tax there, this is what you're actually paying for. And in that, Part A is hospitalization. So when you turn 65, everybody is entitled to Part A of Medicare. It's got a $1,408 per occurrence deductible. Afterwards, Medicare pays 80% of what are the allowed charges during days 1 through 60, and then you pay 20%. If you exceed that, then there's some co-pays that you pay for each day you're hospitalized beyond that. But it covers semi-private room rates, meals, general nursing, medications that are in the hospital. Pretty much all of your hospital type services are all going to be covered under that Part A of Medicare. Now, Part B is an election, and that's something that you have to reach out to Medicare and say, hey, I want this. And in doing so, you're typically, most people are going to pay $144.60 for Part B of Medicare. It is subsidized at that rate. So if you're a higher wage earner in the last 2 years, Medicare always looks back 2 years to see what your adjusted gross income was. And depending on your income, it could put you into where you actually have a surcharge on that premium. But Part B is all of your outpatient services. And every year, what you pay for it and the deductible kind of modifies a little bit. So currently, it's $198 for an annual deductible for Part B. And then after that, Medicare pays 80%, and you're responsible for 20% forever, which is going to cover your outpatient doctor services, labs, x-rays, ambulance, things like preventative flu shots. So under Part B, again, it's an election that you choose when you're ready. So sometimes we tell people if they're currently employed and on a good group health plan, don't elect Part B. Go ahead and take A, but hold off taking that Part B until you're actually ready to retire. And then at that point, you've got 7 months to enroll in Part B, penalty free. Okay. Go ahead and move to the next slide. The next part is we're going to skip something and we're going to jump to Part D. We're going to skip C for a second. But Part D is all of your outpatient drug coverage. So what you're going to do here is, depending on the type of Medicare supplement that you purchase, if it's a supplement, you're going to pick up a standalone prescription drug plan. That's called a PDP. And it's completely independent of your Medicare plan. Or if you buy a Medicare Advantage plan, it's generally built in, so you're not having to buy something separate. The important piece here to understand about Part D is when you become eligible, if you do not enroll in a Part D plan, there's a 1% penalty per month for every month that you go without a prescription drug plan for the rest of your life. So if you said, Steve, gosh, I'm real healthy and, I don't take any medications. I don't want to pay $15 a month for something that I don't use. Well, the problem with that is I'm certainly going to encourage you to enroll in a plan. But if you don't, and let's say you go 2 years without a prescription drug plan, and then you say, well, now I'm on a medication, I better get one. You've got a minimum of a 24-month or 24% penalty that's going to carry over for the rest of your life at the point where they allow you to come in during open enrollment. And so you always want to make sure that you've got a prescription drug plan built into your coverage. Now, the next piece is Part C. Part C is Medicare Advantage, and Medicare Advantage is just private health plans that are in contract with Medicare to provide Medicare services, which are generally going to include additional things like all your preventative, the myriad of preventative services. Everything is going to be, for the most part, copay driven, so there's generally no deductibles. They're going to limit your out-of-pocket exposure. Part D, the drugs, is usually built into the plan, but you start picking up additional things like gym memberships and vision coverage, dental, and many, many more benefits that, like hearing, that are going to be found in an Advantage plan that are not going to be found in a traditional Medicare supplement. All right, go ahead, next slide. So kind of moving to life insurance, there's two general types. There's term life insurance, and when we buy term life insurance, we're buying it for a predetermined amount of time, like 10, 15, 20, or 30 years. At the end of that, everybody always wants to know, well, what happened? Well, it's either going to terminate or it's going to convert to what's called an annual renewable term. And if it converts to an annual renewable term, what's going to happen is they're eventually going to price you out of the market. You'll go from paying $60 or $50 a month to something that's like $600 to $800 a month the next year. Then it might be $10,000 a month the following year. So insurance company will basically price you out of that product. It is considerably less than permanent insurance. And quite honestly, most people are going to buy term insurance to begin with. That's what we recommend here at Medical Plans of Idaho. Tree City Advisors, for the most part, is going to direct you into a term versus a permanent policy in most cases.
Yeah, Steve, I would agree with that too. Kind of touching on the term piece. I mean, it's cheap for the most part. I mean, if you look at if you're younger, if you're in your younger years, you have a family. I will say when we usually have our first meeting with clients, a lot of times they're underinsured, and I found this quickly mature out of a spot where you don't need life insurance, but you get married, you have a spouse, you have little ones, you have kids, you get a mortgage, you have these obligations. And let's just take life insurance for what it is from that scope. It's if you were to pass away, you need to make sure that your dependents aren't impoverished or have to fire sell assets just from the loss of income.
Yep, absolutely. Absolutely. So permanent insurance, generally you're purchasing this for a lifetime. You see a lifetime need for insurance, and it's going to cover you until you die or to age 121. That's just a mortality number that the insurance companies use for pricing. But at 100 or age 121, that's pretty much the expectancy of that policy. It's definitely much more expensive, 3 to 4 times more. You can build some cash value up in these policies. The purpose behind building the cash value generally is to help offset the higher cost of the insurance as you age. You can use these for more complex cases, like estate planning. There's times when Jeremiah and the team over at Tree City would say, you know what, we need to look at something very specific here. And that's when we might put in a permanent life policy. Like if you ended up with a huge estate and we've got estate tax issues, life insurance works very well for that purpose, to help pay those taxes somewhere down the road.
Agreed. Few and far between where we run into scenarios with that. I'd usually say probably 9 times out of 10, keep it term.
Yeah, exactly.
Keep insurance and keep investments. When you start to mix the two, that's when it becomes expensive and complicated, and usually doesn't pan out to the result that you thought you were getting into in the beginning of it.
Right. A lot of people ask me, well, how much life insurance do I need? Well, a good general rule of thumb is take your annual income and multiply it times 8 to 12 times. This is just going to give you kind of a beginning range. Remember, the idea behind life insurance is to replace the lost income of the person who passed away. So a lot of times what I do is I take things into consideration, like what's your current debt load, the number of children you have, the age of your children. Do you need to go back and get re-educated? There's a lot of times that maybe you've got an education in something, but now your interests are different. And if you had to go back into the workplace, you need to be re-educated just to step back in. So we need to build that into the equation. Homes, vacations, you're going to need time off and time away just to overcome the loss. So we need to figure out how much insurance you need, to survive that, because your life's going to change for the next 5 to 8 years if something is going to happen and you lose a loved one, especially one who is, the primary breadwinner in the household. So, let's start with 8 to 10 times, and that gives us a place to begin. And then we can, depending on savings, we can back it down. If we've got a lot of debt or a number of children that we need to get educated, maybe we need to bring that up a little bit. So the 8 to 10 times is a good place to start. A lot of people want to know, well, gosh, how do I buy it? For some reason, it's one of those things where most of us don't want to talk about life insurance because we're afraid of our own death. So my suggestion would be, go contact a good, competent broker. Somebody that can look at multiple carriers based on your situation. I'm working with some people right now. They have some hobbies that are a little bit on the risky side. And so we're shopping that between a couple of different companies right now to see which one's going to give us the most favorable results. Think of it this way. You need somebody who's working on your behalf, not the behalf of any insurance company. So if they only have access to one company, it's time to move on. You want to determine the type of coverage that you need. Is it term or is it going to be a permanent need? Again, most of the time, you just need insurance during the early years of life, and hopefully as you go along, you've been able to save and invest, and eventually you don't have a need for life insurance as you get close to retirement age. Determine the amount that you need. Again, if you need some help, there's lots of people out there that can help you, determine that amount. And then, of course, you need to apply now. And I say that simply because you're the healthiest you're probably going to be right now today, as opposed to 5 years from now. So we never know what tomorrow brings. So apply today, buy as much coverage as you can, and buy the highest amount that you can. Next slide. So when you do the decision to buy insurance, life insurance companies are going to evaluate your risk. So they're going to look at a lot of things. They're going to ask lots of medical questions. They generally are going to require physical exams, blood and urine draw. They're going to look at your driving record. They're going to look at family history of certain deaths prior to age 60. Most of them are going to write off for what's called an attending physician statement. That's just a statement from your doctor. And realistically, the process usually takes 4 to 6 weeks, sometimes longer, depends on doctors' offices and what's being asked for. But the big thing here is get the process started. A lot of times people get hung up over, well, I'm not sure if I want to do a 20 or a 30 year. Here's what I say. Let's apply for a 30 year. Let's get through the process. And once the insurance company makes that offer, we can always modify it. We could make it, instead of $1 million, we could make it $750,000. But if we start and apply for 750, and then we want to raise it to $1 million, the insurance company goes back to line one there. They're evaluating risk. What happened between the time we applied and now that you want to raise the face value? So they're going to go back in and they're going to want to, determine, did something change? So always apply for as far out as you possibly think you'll need and the most insurance that you'll need. Again, you can always modify it. So moving to disability insurance is probably the least purchased product, but yet in my opinion, it's one of the most important, because what it is it's your ability to insure your own income. And anyone who has a W-2 or a 1099 should consider purchasing disability insurance. Statistically, realistically, you're going to use it at some point in your life. There's a couple of different ways you get it. If you can get it through your employer on a group basis, that's absolutely the best way to do it because it's the least expensive. Or you can do it through an individual private policy. It's going to be based on your adjusted gross wages. So if you're a small business owner, we're going to take out all of your business income and we're going to get right down to what do you actually earn and pay taxes.
And Steve, real quick on this, when we're talking about like available through employer group plans, because I would say for most individuals out there, when they work for an employer, a lot of times they have these group benefits, and a lot of times that there is a small life insurance policy built in. Like that's just for burial and things like that, very small amount. And they usually have a small disability, and these smaller policies that are just kind of aggregate in the group. And then a lot of times they can buy supplements within that same group policy, correct?
Correct.
Okay.
Yeah.
So that could be something that you look at as low hanging fruit. You just and you find out what works best for you, of how much coverage you actually need, whether it's in the form of life or disability. And then if you work for an employer that offers that, perhaps you can get a more favorable rate or more favorable cost coverage. However, when it comes to life insurance, and this is a thing that Steve and I, we are very adamant about making very well known, If you get the carpet pulled out from under you from your employer, voluntarily or involuntarily, what goes away with your job? Your benefits. So it's very important to diversify your coverage of insurance outside of your employer, because as soon as you lose that employment, those benefits go with it.
Right, absolutely. Thanks, Jeremiah. That's a key. Another thing, they're going to look at your age, they're going to look at your health status, and the big thing is your occupation. They're also going to have a lengthy application that you're going to have to fill out, pretty much just like life insurance. They're going to reach out for attending physician statements, and usually they're going to want to see several years of income taxes to prove your actual income. So there's different types. There's private policies, and of course there's group policies. Most private policies are going to be longer term, so we're buying for like a 3, 5, 10, or a benefit to age 65. Group policies come in 2 flavors. There's short term and there's long term. Just like a private policy, you can do a long term, but there's also a short term disability option as well. And that's where generally after maybe a 7 or 14-day illness, you could have disability. If you're going to continue to remain out of work, you could have that cover you for 12 to 24 months. Usually that's about the length of a short-term policy. And at that point, then you're either going to leave your employment or you're going to roll into long-term disability at that point. Something that's really important though in disability, and it's understanding some definitions. There's what's called any occupation and own occupation. And when you buy a disability policy, you want to read the definition. If it's an any occupation, it means that if you can wave your hand at Walmart, you can be a greeter, you're not disabled. These are typically going to be very low cost type plans, simply because the definition of disability is pretty broad there. On the other hand, you want something that says own occupation. This means your current job, your current employment. So if you're a surgeon and you get disabled and you can't do surgeries any longer, you're disabled. But if it was an any occupation policy and you can waive, or you can be retrained to sell health insurance, you're not disabled and the policy won't pay. There's also policies, and even under an own occupation, it helps reduce some of the premiums, where after a certain period of time, like 2 years of being disabled and deemed that you're going to stay disabled for long term, it may give the option of paying for you to be re-educated into a new employment. And there's nothing wrong with that. It's just you've got to decide, is that the kind of coverage that you want or not? But it's definitely going to help reduce some of the premiums. Because again, you're either going to buy a policy that's going to go 3, 5, 10, or clear to age 65, as far as continuing to pay you the benefit. But always try and get a policy that's got own occupation. So disability carriers, they're typically going to pay somewhere between 60 and 65% of your taxable income. So if you make $100,000 a year, the most it's going to pay is somewhere between 60 and 65%. Now, there are some industries or occupations that they may pay a little bit more, or they'll pay a little bit less. But we just have to run that through the underwriters to see where they're at. So there's different moving parts, and it's important to understand that with disability, there's about 3 components that we're looking at. We're looking at waiting periods, which is the time before they're going to actually start paying. So on a long-term disability, it's usually 30, 60, or 90 days. And you kind of have to think of that as like as a deductible. It's not going to pay for the first 90 days, but once 90 days kicks, it's going to pay from that point forward. There's a monthly amount. So this is how much they're going to pay, like say $4,000 a month. And then there's the duration, and that's how long it will pay for that disability. So an example would be a 90-day waiting period. It'll pay $4,000 a month to age 65, right? So that's kind of running through a bunch of different types of policies fairly quickly for you here during the lunch hour. We want to open this up to questions that you may have. So Todd, I'll let you take it from here.
And Steve, but Todd, before you go, I just wanted to touch on this question that Jessica hit on the very beginning.
Okay.
She mentioned, I want to make sure where to go. There are so many insurance options out there, varying deductibles, some allowing HSAs and FSAs. Also, the vocabulary can be hard to decipher when it's time to use your insurance. So I think it would be helpful to explain there's an HSA, there's an FSA, there's an Idaho MSA, like there's all these different acronyms for this. So kind of explaining how we can utilize them.
Yeah. So real quickly, an FSA is done through your employer. It's a pre-tax benefit where at the beginning of the year or when you become eligible, you pledge so much money. Currently, I think the max is about $2,500 a year. So let's just say that you pledge $100 a month out of your paycheck. That would go into a flexible spending account. And then when you have a medical expense, you either use a debit card to pay for that, a Benny's card to pay that expense in a pre-tax environment, or you'll pay for it and then bring that receipt back to the administrator who will reimburse you in a pre-tax benefit. Okay.
So for the flexible spending account, just to make sure it's FSA, and it's one of those things where if you do not use it, you lose it. So it's generally over a year that you put that money in, you have a year to use it. It does not carry over to the next year. So if you have a good kind of a good base of what what your out-of-pocket medical expenses are throughout the year, then that's usually the amount you want to fund in your FSA and then pay for those medical expenses for it. It's tax-free money to you. Definitely should be a vehicle utilized.
Yeah, definitely. So if you know you're taking a high blood pressure medication and you buy glasses, once a year, figure out what those expenses are and run them through that flex spending account, because it's money that you don't have to pay taxes on, that you're going to spend regardless anyway. Now, moving to an HSA is a health savings account, and an HSA is you got to have a qualified high deductible health plan in order to operate it. You can put more money into the account. So depending on your age, if you're under the age of 55, you can put $3,550 this year in as an individual. You can do $7,100 as a family, as a contribution. And then in addition to that, if you're over the age of 55, you can make an additional $1,000 contribution as well. So you can do $8,100 as a family. That money goes into the account, it goes in tax deferred, and it comes out tax-free if it's used for qualified medical expenses.
So this HSA account, it's such a powerful tool in terms of retirement planning. Because if you think about this, the money goes pre-tax, you get a tax deduction. If you haven't invested, and some HSAs allow you to do this, you could get growth. It's all tax deferred. So you could literally get a huge gain in something, sell it, and you don't pay any taxes on it. And then way down the line or sooner rather than later, when you pull the money out and use it on a qualified healthcare expense, it's tax-free. So you got a tax deduction on the front end, tax-free growth in the middle, and tax-free distribution for a qualified medical expense. And it's a laundry list of qualified medical expenses. I'm talking sunblock SPF over 15 is a qualified medical expense. So of course it depends on the healthcare plan that you have. Steve mentioned it, you have to have a high deductible healthcare plan. So, and that's the rub where you gotta choose it. So for my family, last year we chose the low deductible plan. So we were not HSA eligible because we kind of knew that we were gonna meet our deductible for 2020. 2021, we are not anticipating that. We're young, we're healthy, we rarely see the doctor. So we're gonna flip it to the high deductible plan for 2021 and be able to utilize the HSA. So it's a strategy that you can kind of bob and weave with year over year.
You can, yeah. And it's really important to understand that the money is your money in your bank account. So here's the great thing: CapEd has HSA accounts.
We do. So
as a member, you can go to CapEd and get your Visa debit card, create your HSA, and start making contributions in there in a pre-tax environment for yourself. It's a win-win situation for most people. And if you don't spend the money, it rolls over to the next year. It's yours. It doesn't go away. Okay. And the best part about an HSA is at some point, we're all going to hit Medicare age. When we get there, we can start paying for some things out of that account that nobody else can. So if you have an HSA, you can pay for your Part B Medicare premiums. You can pay for a Medicare Advantage health plan. You can pay for a prescription drug plan. You can pay all of your retirement medical expenses in a pre-tax environment. If you don't have one of these accounts, you're going to pay for it with all after-tax dollars. It just makes sense to do this in almost every situation if it's available.
Idaho MSA, the medical savings, real quickly.
Yeah, and so the next one is, and this might be worth the price of admission today in and of itself, is the Idaho MSA. The Idaho MSA gives you the ability to make a contribution as an individual up to $10,000 or $20,000 as a family to pay for medical expenses. But here's the caveat. If you are self-employed or you work for somebody that doesn't provide a small group health plan, and you have to buy your own insurance, you can pay not only the medical expenses, but you can pay your health insurance premiums through this account as well. All you're doing is you're taking it from your personal account, transferring the money into your Idaho MSA, and then paying your favorite insurance company. By doing that, you're washing the state of Idaho income tax off of those dollars. So if you make a $10,000 contribution throughout the year just paying premium, you just save $750 in taxes at a 7.4% tax rate here in Idaho.
I'll give you a perfect example of this. We have a household that we worked with throughout the years, and they retired early. They make too much income to get a advanced premium tax credit towards their healthcare plan. So they're paying the full pop and the premium's high, probably to the tune of about $18,000 a year just in medical premiums. Well, they're married filing jointly. So they're basically max funding that Idaho MSA with CapEd, because the CapEd does offer Idaho MSAs. And then they just automatically pay their premiums through that. That's based on that, roughly, they're saving about just north of 12 grand a year. Oh, sorry, not 12 grand, 1,200 a year.
1,200.
And it doesn't seem like a lot, but you compound that over a few years, that is significant saving.
Absolutely.
It's money that you're spending anyways. Why not just wash it through that account and get that money saved?
Right. The vast majority of people that I talk to on a day-to-day basis have no clue that the Idaho MSA even exists. This has been around I've been doing this for 26 years. I've known about it for probably a good 24 of those years, and have been advising people to create these accounts and start paying their premiums and their expenses through the account. Here's the other thing. You do not even need a health insurance plan if you're going to run the Idaho MSA. The best part of this, again, is CapEd can take care of both of these accounts for you. And Todd, hopefully I'm not speaking out of turn here, but CapEd doesn't charge a fee.
We do not charge a fee for either the HSA nor the MSA. That's a product and service that we want to provide to our membership, because we know that the medical items and health insurance, those can be complicated items. We want to keep them as simple as possible, and that means no fees. So I think that is a great gold nugget for those of us, or for those of you who have stayed with us. Beyond that, I think we're into the 1:03, so maybe we're just a little past that lunch hour period. So some great golden nuggets as it relates to the FSA, the flexible account, the HSA, the health savings account that's for those that have qualified plans, and then the MSA, or the Idaho Medical Savings Account. Again, the HSA, MSAs are available from CapEd. So I'd like to say thanks to you, Steve, as well as to you, Jeremiah. For those of you who are not familiar with Real Money Pros, it's on KBOI 670. Tune in on 670 AM between 6 and 7 PM, Monday through Friday. They share and they go through these items in real stories, obviously keeping confidentiality of their clients, but gives us all an opportunity to have an understanding of our personal circumstances and circumstances. So Steve, thank you. Greatly appreciate it. I know that you are in that crazy open enrollment period and time frame that just keeps you extremely busy. Jeremiah, thank you. We appreciate you here with us today. And members of the Tree City Advisor Group will join us the week of October 27th, the 27th to 29th, to talk more about investments. So with that, everybody, thank you for joining us for this episode of Lunch Money, a webinar series on financial well-being. And we look forward to seeing you next Tuesday on October 20th. Thank you and have a great afternoon.
Thank you.
Thank you.